Welcome to Griffonomics.
Glad to be here.
So what if I told you that one of the most legally vulnerable, operationally complex companies in America isn't a Wall Street bank?
Right.
Like it's not some firm trading exotic derivatives or a cryptocurrency exchange operating in the shadows?
Far from it, yeah.
What if I told you it's actually the company that puts the sterile plastic wrappers on the syringes at your local hospital?
I mean, it sounds completely counterintuitive when you phrase it that way.
Right.
But when you actually look at the raw structural reality of the medical supply chain right now, it is entirely accurate.
Yeah.
These companies operating quietly in the background of healthcare, they are navigating a labyrinth of hidden liabilities that, most investors never even see.
And that is precisely our mission for you today. We are taking you on a specially tailored deep dive into the financial, legal, and operational mechanics of one of healthcare's absolute giants, Medline Industries. Now, if you're looking for like a breezy 5-minute summary of their recent quarterly earnings, you are definitely in the wrong place.
You're going to want to buckle up for this one.
Exactly. We are going to conduct a highly granular forensic analysis of Medline's 2026 structural reality.
Because it's complex.
It really is. And the sources we have stacked up for you include Medline's SEC filings, so their S1, their 10K, 10Q documents.
A heavy reading.
Oh, yeah. We also have the recent earnings call transcripts, their presentations from the JP Morgan and Barclays conferences, and a series of very sharp legal and regulatory forensic briefs that really dissect their current legal standing.
Which is exactly the caliber of material we need for this.
Absolutely.
Because Medline's current situation is fundamentally a story of
Well,
a growth versus earning power mismatch.
unpack that a little bit.
Sure. So on the surface, if you just look at their top-line revenue, demand is booming.
Right. Hospitals always need their products.
Exactly. But underneath that revenue, there is just this intense amount of structural friction eating away at the bottom line.
Right. The hidden costs.
Yeah, and to really understand that friction, we have to start by looking at the financial architecture they built, specifically when they transition from a private entity to a public one.
Right. And this is exactly where I want to start digging into the mechanics. Because when you look at their S1 filing, which for those listening is the document a company files before going public, Medline didn't just do a standard, simple initial public offering.
No, they certainly did not.
They didn't just issue 1 billion shares of regular stock and call it a day. They used something called an UPC structure.
Yes, the UPC.
An umbrella partnership C corporation. I know it sounds like incredibly dense financial jargon.
It is, yeah.
So break down for us what an UPC actually is mechanically, and I guess why a company would choose to structure themselves this way.
It's a complex structure, but it's foundational to understanding who actually controls the cash inside Medline right now.
Okay, let's walk through it.
Imagine you have a highly profitable private company, which Medline was for decades.
Right, a family business, essentially.
Exactly. Now, when the private equity sponsors and the original founders decide they want to take it public to raise capital, they face a dilemma.
What kind of dilemma?
Well, if they just convert everything into a standard public C corporation, they lose certain tax advantages that exist in private partnerships.
Okay, so they want the public's money, but they want the private partnership's tax breaks.
Bingo.
How do they get both?
They build a two-tiered system. First, they create a brand new public shell company.
A shell company.
Yeah, in this case, that shell is called Medline Inc.
Okay.
This is the entity that actually goes public. This is the ticker symbol you see on the stock exchange.
So when I buy a share, I'm buying Medline Inc.
Exactly. When retail investors or mutual funds buy shares, they are buying shares in Medline Inc. But, and this is the critical part, Medline Inc. doesn't actually do anything.
Wait, really? It doesn't do anything?
Nothing. It has no employees. It doesn't own the warehouses. It doesn't manufacture the surgical kits.
Wow.
It has absolutely no independent means of generating revenue.
So what are investors actually buying then?
They are buying a holding company whose sole material assets are equity units in the underlying operating partnership.
Ah, okay.
And that partnership is called Medline Holdings, LP. The operating partnership is where the actual business lives.
The physical stuff.
Right. The trucks, the patents, the global logistics network, all of it.
Let me make sure I have this mechanic right in my head. It's almost like imagine an incredibly lucrative gold mine.
Okay, I like that.
The actual operating partnership is the mine itself, right? The miners, the machinery, and the gold coming out of the ground.
Yes.
And Medline Inc., the public company, is essentially just a toll booth built at the exit of the mine.
That's a highly accurate way to visualize it.
It holds a legal right to collect a portion of the gold as it comes out, but it doesn't actually operate the mine itself.
That's exactly right. But it gets a lot more complicated when you look at the power dynamics between those two tiers.
How so?
Because Medline Inc., the public shell, is designated as the sole general partner of Medline Holdings, LP.
Okay.
And in partnership law, the general partner holds the steering wheel.
So they have the control.
100% control. That means Medline Inc., controlled by its board and management, has complete voting power and complete control over when and how cash distributions are made out of that operating partnership.
And what about the other partners in this operating entity, the founders, the private equity sponsors who kept an ownership stake?
They're limited partners. They hold direct partnership units.
I see.
So when the underlying business generates cash, Medline Inc. gets to decide when to distribute that cash upward.
But there are rules for that, right?
Yes. The rules, specifically the amended and restated limited partnership agreement, dictate a very strict flow of funds.
Okay.
If Medline Inc. decides to authorize a cash distribution from the partnership, it must do so on a pro rata basis.
Pro rata meaning proportionally.
Exactly. So if the public shell owns, say, 40% of the units, and the private insiders own 60%, any cash distributed has to be split exactly 40-60.
Well, that makes perfect sense. If you are going to pay out the profits, everyone gets their fair share based on what they own.
You'd think so.
But this is exactly where the controversy arises in the sources we reviewed.
Yes, it is.
Because according to the filings, management recently made a very deliberate decision regarding these cash flows.
He did?
They specifically withheld an operational variance of $10 million to $12 million in primary cash distributions.
Right.
They essentially just kept the cash locked inside the operating partnership instead of distributing it up to the shell and out to the partners.
Exactly. And the stated reason for this holdback was to manage elevated variable labor expenses.
And severe liquidity constraints, right?
Yeah, specifically as they were optimizing their home medical equipment distribution networks.
Okay.
They saw a cash crunch coming in their operations, so they decided to hoard the cash rather than distribute it.
Hang on, I have to push back here.
Right.
$10 to $12 million. We are talking about a company that does billions in revenue. Medline is an absolute titan.
Yes, they are.
Why are they causing a structural controversy over what amounts to pocket change for a company of this scale? Like, is $10 million really enough to save their balance sheet?
You're right to question the scale. It sounds small, but you have to look at it through the lens of corporate governance and legal precedent, not just the raw dollar amount.
Okay, explain that.
It is the precedent of the action that matters. When you operate in UPC structure, you are essentially walking a tightrope of fiduciary duty.
Because of the power dynamic.
Right. Delaware corporate jurisprudence, which is where Medline is incorporated, like most major companies, looks incredibly closely at how general partners treat minority unit holders.
Because the general partner could theoretically just starve the minority partners of cash if they wanted to?
Precisely. In Delaware, the courts are fiercely protective of minority partner rights. By selectively withholding this operational cash, or applying what analysts call asymmetric distribution discounts.
Meaning they aren't paying it out strictly pro rata as required by the partnership agreement?
Exactly. By doing that, Medline Inc. is exposing itself directly to breach of fiduciary duty lawsuits.
Wow. So even if it's only $10 or $12 million, the act of violating the pro rata distribution rule is like touching the third rail of Delaware corporate law.
It absolutely is.
It just opens the door for any disgruntled minority unit holder to file a derivative lawsuit against the management.
Yes. And if you read the fine print in Medline's amended and restated Certificate of Incorporation, it explicitly designates the Delaware Court of Chancery as the exclusive legal forum for these types of derivative actions.
And the Court of Chancery doesn't mess around?
They do not. They don't use juries. They use expert corporate judges called chancellors.
Right.
And they do not look kindly on management playing games with the structural flow of funds in a UPC.
But that brings me back to my confusion. If management knows that withholding this cash violates the strict rules of their UPC structure,
Which they definitely do.
and they know it exposes them to lawsuits in a court that favors minority shareholders, why do it?
Right.
The whole home medical equipment optimization excuse just feels really thin.
It does.
If they are willing to risk a fiduciary lawsuit for $10 million, it tells me that $10 million is desperately needed somewhere else. What is actually causing this sudden cash crunch?
And that question leads us directly to the foundational operational crisis they're currently facing.
Let's unpack this.
They need that cash because their primary defense mechanism against their own workforce has completely collapsed.
The labor liability issue?
Yes. We have to look at the recent legal precedent established in the Ninth Circuit Court of Appeals.
Okay.
The case is Degenaire versus Medline Industries, LP.
So let's look at this. Who is Degenaire, and how did this one person manage to fracture Medline's entire corporate defense strategy?
Degenaire was a standard warehouse operator for Medline. And to understand the gravity of this, you have to really visualize the scale of Medline's physical operations.
Because they're massive.
They are. They don't just broker medical supplies digitally. They physically move millions of tons of medical equipment.
Right.
They have an absolute army of logistics workers. And Near's job involved working the shipping docks, stacking pallets of medical supplies, wrapping those goods in industrial plastic, and loading them onto the massive interstate distribution trucks that feed the hospital networks.
A very physically demanding foundational supply chain job.
Exactly. Now, historically, Medline, like many massive logistics companies, utilized a very specific legal shield to protect themselves from wage and hour lawsuits.
Right.
Whenever they hired a warehouse worker, they required that employee to sign a mandatory private arbitration agreement.
For those listening who might not have had to sign one of these on their first day of work, walk us through the mechanics of mandatory private arbitration. Why do corporations love it so much?
Corporations heavily favor mandatory arbitration because it keeps disputes entirely out of the public court system.
It's private.
Right. If an employee feels they were denied overtime pay or denied their legally mandated meal breaks, they cannot go to a public judge.
Okay.
And, more importantly, they cannot band together with other employees to form a class action lawsuit.
Ah, so no class actions.
Right. Instead, the dispute is funneled into a private room with arbitrator, usually selected by an arbitration firm that the company frequently hires.
Which seems like a slight conflict of interest.
Some argue that yes, the outcomes are confidential, the damages are usually capped, and it essentially isolates the legal risk to a single individual rather than a class of thousands.
It essentially prevents a small spark from turning into a massive forest fire.
That's a great way to put it.
If one worker has a grievance, it's dealt with quietly.
Exactly.
So Nair has a dispute with Medline, likely over wage and hour laws, and Medline tries to execute their standard playbook. They tell the court, look at this contract Nair signed. This dispute belongs in private arbitration. Case dismissed.
That was the strategy. But Nair's legal team fought back, and they leveraged a very specific exemption carved out in the Federal Arbitration Act, or the FAA.
Okay, what's the exemption?
Section 1 of the FAA explicitly states that mandatory arbitration cannot be enforced against seamen, railroad employees, or any other class of workers engaged in foreign or interstate commerce.
Wait, I can see where this is going, but I'm a bit confused.
Sure.
Seamen and railroad employees physically cross state lines and international borders all day long.
They do.
But warehouse workers, like Nair, they clock into a warehouse in California, they load boxes in California, and they clock out in California.
Right.
They never physically cross a border. So how can they be classified as being engaged in interstate commerce?
That exact legal friction is what went all the way up to the Ninth Circuit Court of Appeals.
Wow.
And the court looked at recent Supreme Court precedents, specifically cases like Bissonnette and Saxon, which heavily refined the definition of interstate commerce in the modern logistics era.
Okay.
The court determined that it actually does not matter if the specific employee never physically crosses a state line.
It doesn't matter.
No. What matters is the nature of the goods they are handling.
Ah, the flow of the good.
Exactly. Because Medline operates a massive nationwide and international distribution network, the goods moving through that California warehouse are part of a continuous interstate journey.
I see.
The surgical kits might be manufactured in Mexico, shipped to California, and destined for a hospital in Nevada.
So they're moving across borders even if the worker isn't.
Right. The court ruled that warehouse loaders and pallet wrappers play a direct and necessary role in the free flow of goods across borders.
Wow.
Therefore, they belong to a class of workers engaged in interstate commerce.
And because they meet that definition, they trigger the Section 1 exemption of the FAA. Meaning, the mandatory arbitration contract they signed on their first day is legally void.
Completely nullified. The Ninth Circuit handed Medline a catastrophic appellate defeat. They ruled that these workers are completely exempt from forced arbitration.
This is a monumental shift.
It really is.
If I'm understanding the mechanics of this correctly, this doesn't just affect Desjardins.
Not at all.
By setting this precedent at the appellate level, they have legally stripped the arbitration shield away from every single warehouse loader, pallet wrapper, and shipping clerk in Medline's network across the entire Ninth Circuit.
Which covers the entire West Coast.
Yes. Unbelievable.
It is a permanent structural change to their legal risk profile. Think about it. Medline's core competitive advantage is their scale.
Right.
They move massive volumes of medical supplies at incredibly low costs, and they do that by optimizing a massive logistics workforce.
Yeah.
This ruling turns every single one of their distribution centers into a highly vulnerable legal target.
Because now, if one worker misses a 30-minute meal break, they don't go to a quiet arbitration room.
No, they don't.
They go to a public employment lawyer who then files a wage and hour class action lawsuit on behalf of all 3,000 workers in that facility.
Exactly. It opens the floodgates to public litigation.
And how is Medline handling this in their filings?
Well, in their 2026 10K filing, management tries to downplay this. They broadly state that the financial impact of routine labor litigation is difficult to assess or quantify.
Of course they do.
But if you look at the forensic analysis provided in our sources, the conclusion is stark. This appellate precedent mechanically turns labor litigation from a rare, isolated annoyance into an unhedged, permanent expense line item on their income statement.
It's just a cost of doing business now.
Pretty much.
And we already have concrete evidence of this impact from the sources.
Yes, we do.
The sources detail that the Nair precedent immediately catalyzed a massive settlement. Because they could no longer force arbitration, Medline was pushed into a $1.1 million PEGA settlement, that's the Private Attorneys General Act in California.
Right, involving thousands of logistics employees.
And that settlement was finalized in April 2026.
And that is actual cash leaving the balance sheet.
Yes.
When you realize that the legal firewall protecting their workforce has evaporated, that $10 to $12 million cash holdback we discussed in the UPC structure suddenly makes perfect strategic sense.
It totally does.
They are hoarding cash because they know they are facing a barrage of class action settlements.
They need a war chest.
Exactly. They are building a legal war chest, even if it means risking a fiduciary lawsuit from their minority partners, because the threat of wage and hour litigation is far more immediate and pervasive.
Okay, so we have a company whose entire logistics workforce is now a massive unshielded liability.
Yes.
But what exactly is that workforce doing? They aren't just moving cardboard boxes full of generic bandages.
No, they are not.
To really grasp the operational crisis Medline is facing right now, we have to look at the physical products themselves. We have to look at what analysts are calling the kit cannibalization crisis.
This is a fascinating operational bottleneck. To understand kit cannibalization, you first have to understand the core of Medline's business model.
Okay, walk us through it.
You have to understand why hospitals buy from them in the first place. Medline's most powerful defensible asset, what analysts call their sticky moat, is their custom procedure trays, or CPTs.
Okay.
This is the absolute engine of their surgical solutions segment.
Let's anchor this to something real for the listener.
Sure.
Imagine you tear your ACL, or you need a total knee replacement. You go into the operating room. Most people probably assume the hospital supply manager ordered a box of scalpels from one company, a box of surgical drakes from a third, and the nurses just gather them all up before the surgery.
That is exactly how it used to work, and it was incredibly inefficient.
I can imagine.
It required massive inventory rooms in the hospital, and nurses wasted hours pulling individual items. Medline solved this friction. They created the custom procedure tray. Instead of buying individual components, Medline prepackages every single sterile tool, consumable, drape, and sponge needed for that specific total knee replacement into one single customized shrink-wrapped kit.
So the nurse just walks into the supply closet, grabs the Dr. Smith total knee replacement kit, peels off the sterile seal in the operating room, and everything they need is perfectly laid out.
Exactly. And this creates an incredibly sticky relationship with the hospital system.
Right.
Once a hospital transitions to using Medline's custom kits, switching away to a competitor is nearly impossible.
Why is that? I mean, if a competitor offers a kit for $5 less, wouldn't the hospital just switch?
Because the switching costs are astronomically higher than the unit savings.
Okay, how so?
Think about the mechanics of a hospital system. Every single item in that custom kit, is tied to a complex electronic medical record, or EMR inventory code.
Ah, the billing codes.
Right. The billing department relies on those codes to charge the insurance companies. Furthermore, the entire nursing staff is trained on the specific workflow of that Medline kit.
I see.
If you change suppliers, you have to retrain hundreds of nurses, rewrite thousands of EMR billing codes, and risk surgical delays while the staff adjusts.
It's just not worth it for them.
Hospitals simply will not do it. It locks in Medline's market share and guarantees recurring revenue.
It's a brilliant business model. You embed yourself so deeply into the hospital's daily physical workflow that ripping you out would cause administrative trauma.
It really is brilliant.
But this highly integrated model is exactly what is causing their current operational nightmare.
Yes, it is.
Because what happens when the FDA decides that one tiny piece of plastic inside that fully sterile, customized kit is defective?
Then you get the crisis of early 2026. The FDA initiated a massive, sweeping regulatory crackdown. And it happened on two fronts simultaneously.
Okay, what was the first front?
First, the FDA targeted unauthorized Chinese-manufactured plastic syringes, specifically cracking down on major suppliers like Jiangsu Shenli Medical and Jiangsu China.
And Medline uses those syringes in their kits.
Millions of them.
Wow.
But it got worse. Simultaneously, Medline received an FDA warning letter regarding syringes they manufacture themselves.
Oh, internally.
Yes. Specifically, the anemic angiographic control syringes, which are highly specialized devices used in complex heart procedures to inject contrast dye so doctors can see the blood vessels on an X-ray.
And what was wrong with the anemic syringes?
The FDA discovered a manufacturing defect involving excess silicone. The excess silicone was causing the syringes to physically disconnect from the surgical manifolds during the actual heart procedures.
That is terrifying.
It was a severe patient safety risk.
You definitely do not want your equipment falling apart while injecting dye into a patient's heart. So what does the FDA do? They don't just ask nicely for Medline to fix it, right?
No, the regulatory enforcement was absolute. The FDA officially rescinded the 510(k) regulatory clearances for a sweeping array of Medline-branded control syringes, guide wires, and procedural tubing.
Let me stop you there.
Yeah.
We throw around terms like 510K a lot in medical business discussions. Walk us through exactly what a 510K clearance is and mechanically what happens when it gets rescinded.
A 510(k) is a pre-market submission made to the FDA. Essentially, if a company wants to sell a medical device, they have to prove to the FDA that their device is at least as safe and effective as a device that is already legally on the market.
Okay, so it's a benchmark test.
Right. It's the golden ticket to sell medical supplies in the United States. When the FDA rescinds a 510(k), they are legally invalidating that ticket.
Wow.
It means the product is instantaneously unauthorized for use. It triggers an urgent medical device recall.
And this is where the brilliant custom procedure tray business model turns into a structural nightmare.
Exactly.
If Medline just sold boxes of syringes, they would just tell the hospitals to throw the boxes in the trash.
It would be a write-off, but simple.
But they don't sell boxes of syringes. They sell highly complex, fully sterile kits where that unauthorized syringe is already baked inside.
Precisely. And this is the mechanics of kit cannibalization. You cannot just leave the unauthorized syringe in the tray and tell the nurse not to use it.
Because it compromises the whole kit.
Because the FDA requires physical quarantine. So hospitals and Medline's own nationwide distribution warehouses are forced to physically lock down all of this inventory.
I'm trying to visualize the manual labor required here. It's like, imagine you baked a massive multi-tiered wedding cake.
Okay.
It's beautifully frosted, perfect. And right before you deliver it to the reception, the health inspector calls and tells you the specific brand of sugar you used in the second tier is contaminated with salmonella.
That's a disaster.
Right. You can't just unbake the cake. You can't just scrape the frosting off. You have to hire an army of people to meticulously, surgically extract the contaminated sugar without destroying the rest of the cake. It's an operational impossibility.
The reality in the warehouses is very close to that analogy. Because these kits are highly profitable, the Medline brand segment usually operates at a 24% to 26% margin. They can't just throw the whole tray away.
Right. The rest of the tools are fine.
The underlying instruments are still good. So they have to cannibalize the kits. They have to use expensive, unbudgeted manual labor.
Wow.
Workers literally have to break the sterile seals on thousands of prepackaged convenience kits, physically rip out the non-compliant syringes, replace them with authorized components, reseal the packages, and apply compliant overlabels to document the change for the FDA.
Think about the compounding operational bottleneck here. Every single hour, a warehouse worker spends carefully ripping a faulty $2 syringe out of a sterile surgical tray is an hour they are not loading a truck with new inventory.
It grinds the distribution network to a halt.
It does.
Ah.
And if we connect the dots back to our previous topic, think about who is doing this manual labor.
Oh, wow.
Yeah. It's the logistics workforce, the exact same workforce that was just granted exemption from mandatory arbitration by the Ninth Circuit.
Exactly. Medline is being forced to massively increase their manual warehouse labor overhead to deal with the kit cannibalization. At the exact same time, the Nair ruling leaves that very same labor force highly vulnerable to wage and hour class action lawsuits.
That's a double whammy.
If these workers are forced to work through their meal breaks or stay late to unpack thousands of syringes, the legal liability doesn't go to an arbitrator anymore. It goes straight to a public courtroom.
It is a perfect storm of operational friction. You have cash traps, legal vulnerabilities, and a regulatory crisis all feeding into each other,
Yeah.
which inevitably bleeds into the financials. We need to look at the ledger, because when you look at the raw numbers, on the surface, it can be incredibly misleading.
Very misleading.
We need to untangle Medline's gross profit from its adjusted EBITDA to see where the real financial hemorrhage is occurring.
This is where forensic accounting becomes critical. Let's look at the Q1 2026 numbers. Medline's overall gross profit margin fell 250 basis points, landing at 25.0%.
Okay.
And their GAAP net income, which is their standard unadjusted profit, plummeted to 25.8%, down to $239 million.
That's a huge drop.
Even the Medline Brand segment, which is usually their impenetrable profit engine, saw its margin drop from that historical 26% down to 22.1%.
So the margins are getting crushed.
Mhm.
And as an observer, I immediately assume this is because of the kit cannibalization.
That would be the logical conclusion.
Right. I assume the cost of hiring all those workers to rip open sterile trays is what destroyed the gross margin. But when you read the transcripts from the Q1 earnings call, management explicitly pushes back on that narrative.
They do.
They stated on the record that the syringe recalls and the inventory write-downs were actually immaterial to our financials.
Which is a fascinating disclosure. If the FDA recalls didn't crush the gross margin, what did? Management points directly to a massive, unexpected $85 million incremental hit from import tariffs.
Okay, let's break this down. $85 million in SNAP tariffs. Usually when a company faces supply chain inflation or new tariffs, they just raise their prices.
Wow.
We see at the grocery store all the time. The cost of wheat goes up, the cost of bread goes up. Why can't Medline just pass this $85 million tariff cost directly onto the hospital networks buying their kits?
Because the medical supply market does not operate like a grocery store. Medline sells the vast majority of its products through GPOs, group purchasing organizations.
Define that for us. How does a GPO change the pricing dynamic?
A GPO is an entity created by a collective of hospitals to leverage their combined purchasing power. Instead of one hospital negotiating for syringes, a GPO negotiates on behalf of 1,000 hospitals.
Okay, huge volume.
And because they represent such massive volume, they demand rigid, multi-year, fixed-price contracts. Medline is locked into these contracts. When the federal government suddenly slaps an $85 million tariff on imported medical plastics, Medline cannot just send an email to the GPO and say, hey, prices are going up 5% tomorrow.
The contract forbids it.
Exactly. The prices are legally locked. So Medline just has to eat the entire $85 million cost inflation. It hits their cost of goods sold directly, which mechanically compresses their gross profit margin.
That perfectly explains the top-line margin squeeze. But as we move further down the income statement, we get to a metric that companies love to highlight, adjusted EBITDA.
Yes, their favorite metric.
And this is where the forensic analysis reveals some incredibly aggressive accounting choices.
Adjusted EBITDA stands for earnings before interest, taxes, depreciation, and amortization. It is a non-GAAP metric, meaning it doesn't follow standard accounting rules.
Right.
Management gets to adjust it by adding back certain expenses that they consider to be one-time anomalies to give investors a look at the true operating run rate of the business.
It's essentially the company saying, ignore this messy stuff that happened this quarter. Look how healthy our core business is.
Exactly.
For Q1 2026, Medline reported an adjusted EBITDA margin that fell to 10.6%, landing at $776 million. And the sources note this was dragged down by an incremental $27 million increase in outbound freight and logistics and another $27 million in transitory public company costs.
Which included a massive $18 million charge for one-time employee IPO bonuses.
Wow.
Plus, elevated fuel costs are eating about 50 basis points of their margin.
That is the narrative they present. But the real forensic detail, the hidden balance sheet cash trap that is deliberately excluded from that adjusted EBITDA calculation, is a monumental $166 million global toxic tort settlement.
Yes, I read this in the briefs, and I was genuinely shocked by the mechanics of how they are handling this. Let's walk the listener through this crisis, because it has nothing to do with syringes or tariffs.
Medline faced an existential legal liability in Waukegan, Illinois.
Yes, they did. Medline operates massive sterilization facilities. To sterilize medical equipment, they use a highly effective but highly toxic gas called ethylene oxide, or ETO. The surrounding community in Waukegan filed massive toxic tort claims, alleging that the ETO emissions from the Medline facility were causing elevated cancer rates in the neighborhoods.
A completely devastating allegation.
Absolutely. To resolve this, Medline entered into a global settlement requiring a massive $166 million cash payout, which was finalized and paid in the second quarter of 2025.
And here is the crucial accounting nuance that listeners need to grasp.
Right.
Medline explicitly defines their adjusted EBITDA metric to exclude any charges related to litigation. So they pay out $166 million to settle cancer claims, but they just erase that number from their adjusted EBIT calculation.
It makes their headline operating margins look completely insulated from the legal fallout.
It creates an optical illusion of stability, but the forensic reality is found on the cash flow statement, because usually when a company pays out a massive settlement, their corporate insurance covers it.
Right. They pay the $166 million, but they record an insurance receivable on the balance sheet because they expect the insurance company to reimburse them.
But the briefs show that Medline is locked in a massive civil war with its own excess insurance carriers.
Because the insurance carriers are invoking pollution exclusions. Standard corporate liability policies almost always contain clauses stating they will not cover damages caused by the discharge of pollutants or toxic chemicals.
I see.
The insurers are arguing that ethylene oxide emissions clearly fall under this exclusion.
So the insurance companies are flat out denying coverage. They're refusing to pay.
Exactly. Because of this denial, Medline cannot legally record an offsetting insurance receivable on their balance sheet.
I want to make sure I'm grasping the magnitude of this. They pay $166 million in cold, hard cash for a toxic emissions settlement.
Yes.
Because of an accounting adjustment, it completely bypasses the adjusted EBITDA metric, so the headline earnings look fine. But because the insurance company denied the claim, that $166 million is entirely out of pocket. It is gone.
It is a massive, unreimbursed drain on their corporate working capital. It depletes their actual corporate wallet, exacerbating the broader supply chain margin squeeze caused by the $85 million tariffs and the unquantifiable labor litigation risks.
Okay, if I am the management team at Medline, I am looking at a truly terrifying dashboard.
It's grim.
I have $85 million in tariffs that I'm legally forbidden from passing on to my hospital customers because of GPO contracts. I have a $166 million hole in my balance sheet from an unreimbursed toxic tort settlement.
Right.
My primary competitive moat, the surgical kits, is being cannibalized by FDA recalls that require massive manual labor.
Yeah.
And the workforce required to do that manual labor was just granted the legal right to file class action lawsuits against me.
It's a lot.
How does a company survive this? How do they grow their way out of a structural trap this deep?
The answer is drastic, and it requires a fundamental shift in how the company physically operates. Medline has realized that human friction, whether it's the cost of manual labor or the legal liability of wage and hour lawsuits, is their greatest existential threat.
Sure.
Their only way out is to fundamentally remove human friction from the equation entirely. Enter the $1.4 billion automation moat.
$1.4 billion in capital expenditure. They are betting the entire future of the company on robotics. Let's look at the physical deployment of this technology because it is fascinating. The centerpiece of the strategy is their partnership with a company called Symbotic.
Yes.
Medline is officially the first healthcare company to deploy the Symbotic system, which is an AI-powered robotic platform.
To understand why Symbotic is so revolutionary, you have to understand the inefficiency of a traditional warehouse.
Okay, paint a picture for us.
In a standard Medline distribution center, the vast majority of the physical real estate is taken up by bulk pallet storage. You have massive wide aisles so human-driven forklifts can navigate and pull heavy pallets down from the racks.
Right, standard warehouse stuff.
It requires a huge building footprint and it requires hundreds of humans driving machines.
So how does Symbotic change that architecture? Are they just using self-driving forklifts?
No, it is a complete architectural redesign. Symbotic replaces the traditional racks with a dense, three-dimensional vertical grid.
Oh, wow.
There are no wide aisles for forklifts because humans aren't allowed inside the structure.
Yep.
Instead, a fleet of high-speed autonomous robotic rovers drive freely on top of and inside this 3D grid, acting almost like a Rubik's Cube, retrieving and storing cases at incredible speeds.
The metrics provided in the sources for this system are staggering.
They really are.
Medline is starting their first pilot in 2027 at their Ohio distribution center. They project that integrating the Symbotic AI will reduce their required warehouse labor by roughly 50%.
Half their workforce.
And because they don't need forklift aisles, they actually increase the building's physical storage capacity by 40% simply by shrinking the internal footprint. They can store almost double the supplies in the exact same warehouse.
And that is just for the bulk pallets. They are pairing Symbotic with their existing auto store integration, which handles the smaller items.
What's the difference there?
Think about a hospital ordering 5 boxes of sutures rather than 5 pallets. That is called less-than-case picking, and it actually makes up 70% of Medline's order lines.
Oh, okay.
They already have 2,100 auto store robots managing this inventory across their network.
And the AutoStore metrics follow the same trajectory. It decreases the human labor required to pick an order by 75%. It increases the throughput, the speed at which orders are fulfilled, by a factor of 2.
Yes.
And it decreases the required physical footprint for small items by 66%. But what fascinates me is that they aren't just automating the physical movement of the boxes, they're automating the digital decision-making behind the scenes.
This is a crucial element. They built the Empower Digital Control Tower in partnership with Microsoft.
Okay.
They are expanding this platform to the majority of their acute care hospital customers by the end of 2026. Empower is a predictive AI system that monitors supply chain disruptions.
How does it work?
If a specific brand of surgical glove is suddenly stuck on a cargo ship in the Pacific, the Empower AI automatically identifies the shortage and delivers a greater than 50% efficiency gain in executing order substitutions.
So it instantly reroutes alternative gloves to the hospital before they even realize there is a shortage.
Exactly.
Okay, the efficiency gains are obvious. But if we connect this massive $1.4 billion technological deployment back to everything we discussed in the first half of this deep dive, this isn't just about speed.
No.
It isn't just about saving real estate or optimizing supply chains.
It is much more strategic than that.
It is a direct physical hedge against the narrow arbitration loss. Think about the mechanics of what we just described.
Right.
If the Symbotic and auto store robots reduce the warehouse labor burden by 50% to 75%, Medline physically requires thousands fewer human warehouse loaders, forklift drivers, and pallet wrappers to move the exact same volume of medical supplies.
This is the ultimate corporate defense strategy. Even if Medline's legal team cannot accurately quantify the exact future dollar liability of wage and hour class actions.
Because the mandatory arbitration shield is permanently gone.
Right. Accelerating this automation strictly caps their legal exposure.
But let me push back on this. Surely they still need humans to operate the warehouses.
Of course.
You need technicians to maintain a $1.4 billion fleet of autonomous rovers. You need software engineers. Does this actually eliminate their legal risk, or does it just change the type of worker they are hiring who could still theoretically sue them?
It doesn't eliminate the risk entirely, you are correct. But it radically alters the volume and the classification of the risk.
How so?
A highly paid salaried robotics technician working an 8-hour shift monitoring a computer screen is significantly less likely to file a wage and hour lawsuit over missed meal breaks or uncompensated physical overtime.
Than a warehouse loader pulling 12-hour shifts stacking heavy pallets manually. So they're fundamentally shrinking the target on their back.
Yep.
Every single Symbotic robot they purchase and deploy is one less human worker who can legally join a massive class action lawsuit.
That's the reality of it.
It is a brilliant, albeit slightly dystopian mechanical hedge against legal liability. They are replacing legally vulnerable human labor with legally immune robots.
It is the ultimate answer to wage inflation and arbitration defeats. But the critical question for the financial markets is the timeline.
Right.
Can they deploy these robots fast enough?
Huh?
How is Wall Street pricing this high-stakes race between a $1.4 billion technological deployment and mounting immediate legal and tariff headwinds.
Let's deconstruct the valuation and what the sources refer to as the technical supply overhang.
Okay.
When you look at Medline's stock chart recently, it faced immense technical gravity. The price was heavily depressed, largely due to an 86.25 million share secondary offering, which priced at $41 per share. That is a massive float dump onto the public markets.
And we have to understand the mechanics of why that float dump happened. It wasn't because the company was failing.
Right.
It was driven mechanically
Right.
by the liquidating positions of their original private equity sponsors, namely the heavyweights, Blackstone, the Carlyle Group, and Hellman and Friedman.
Why does a private equity firm liquidating their shares cause the price to drop artificially?
Because of the sheer volume of supply, private equity funds operate on specific timelines. They buy a company, hold it for a few years, take it public, and then they have a fiduciary duty to their own investors to return the capital.
Oh, I see.
When 3 massive private equity funds decide to liquidate 86 million shares simultaneously, the market simply cannot absorb that much supply at once without the price dropping.
That makes sense.
It creates a temporary technical supply overhang that depresses the share price, regardless of the underlying fundamental health of the business.
It's like trying to force a river through a garden hose. The market chokes on the volume. But the sources contrast that private equity exit with a very different signal from the original founders. The Mills family, who founded Medline, retained a strong 17.8% voting power through an entity called Mozart Holdco. They aren't running for the exits alongside Blackstone and Carlyle.
Which signals deep insider confidence in the long-term structural health of the company.
So if I'm analyzing this, if the stock price was artificially pushed down to $41, strictly because private equity sponsors were mechanically forced to dump shares, and that overhang is now clearing as the market finally absorbs all that supply,
Yes.
doesn't this essentially create a massive arbitrage opportunity for investors, assuming the core business can actually survive the headwinds we discussed?
That is the ultimate strategic verdict we need to evaluate to close out this analysis. Is the core business healthy enough to capitalize on that clearing technical overhang?
What did the numbers say?
And when we evaluate the growth versus earning power mismatch, the evidence for the top-line engine is undeniable. Despite the gross margin squeeze from the $85 million tariffs, despite the FDA kit cannibalization, actual end market demand is booming.
The Q1 2026 numbers validate that. Total net sales grew 10.7% to hit $7.4 billion in a single quarter.
Incredible growth.
And management was confident enough in their market position to raise their 2026 organic sales growth guidance to a highly robust range of 8.5% to 9.5%. You don't raise guidance if hospitals are abandoning your platform.
Exactly. They're winning major multi-channel deals, they're displacing legacy competitors left and right, and they recently crossed a major international threshold.
Oh, the Canada deal.
Yes. They just signed their very first prime vendor customer in Canada, partnering with Mohawk Medbike Corporation to serve a massive network of hospitals in Ontario. The demand for their custom procedure trays is only accelerating.
Okay, let's synthesize this entire deep dive and figure out what the next 18 months look like. Medline is a paradox.
They are?
They possess a Medline brand engine that fundamentally wants to run at a highly lucrative 24% to 26% margin because their products are embedded into the hospital infrastructure in a way that makes switching costs impossibly high.
But that powerful margin engine is currently trapped inside a 10% adjusted EBITDA reality.
Because it is weighed down by a trifecta of structural crises. They are eating $85 million in unpassable GPO tariffs. Their operational warehouses are bottlenecked by FDA crackdowns forcing expensive manual kit cannibalization.
Right.
And their core logistics workforce has been left legally exposed by the catastrophic Nair arbitration defeat, opening the floodgates to class action lawsuits.
The entire question of whether Medline deserves a valuation re-rating hinges on execution. It all comes down to the robots bailing them out in time.
Right.
Can they scale the Symbotic AI and the Empower tech stack fast enough to permanently replace human labor, permanently lower their variable cost per pick, and neutralize their legal liability before those unreimbursed $166 million toxic tort cash traps drain their working capital entirely?
It is an incredible race between technological salvation and legal gravity.
It is. And as we conclude, I want to leave you with one final thought to mull over regarding that technological salvation.
Do.
We talked heavily about the Microsoft Empower AI control tower managing supply chains, but think about the logical conclusion of that technology. Medline has stated that in the near future, this predictive AI will utilize integrated cameras installed directly inside hospital supply rooms, visually monitoring raw materials on the shelves in real time.
So the AI is physically watching the inventory deplete.
Yes. Now imagine what happens the very second an FDA 510K rescission hits the wire. What happens when the AI is so deeply integrated that before a human supply manager even has time to open the FDA warning letter, the Empower system automatically reroutes global inventory.
And cancels inbound shipments of the defective syringe.
Exactly. And digitally locks the hospital supply room door to physically quarantine the non-compliant parts. We aren't just looking at an automated warehouse designed to offset manual labor costs. We are looking at the birth of an entirely autonomous, self-healing medical supply chain.
That is a staggering concept. An artificial intelligence that can instantaneously diagnose and heal its own structural disruptions without human intervention. That is the future they are building, if they can survive the present. Thank you for joining us on this incredible exploration of the mechanics behind the medical supply chain, risk-defined, portfolio-protected,